Welcome everyone to Macroeconomics, exercise class session 6. In the first part we would look at a labor market model, and then in the second part we would look at a SAD model. So problem number 19 is concerning a labor market model. Analyze different shocks in the labor market model graphically. How do real wage and natural or structural rate of unemployment change? So here you have two formulas. The first one is saying wage over price is a function of U and Z. The second one is saying wage over price is equal to 1 over 1 plus mu. W in our formula, in our equation number 1 or 2, represents nominal wage, and P represents our price level at that time and period. So wage over price would give us a real wage. So this is to say nominal wage divided by price would give us a real wage. W in our formula, as you have just seen in the first equation given here, U in our formula is unemployment rate. UN is natural or structural unemployment rate, which we would see in the later part of this exercise when we do the graphical analysis. So Z in the first equation given here is variables that contain all exogenous variables which have an effect on the real wage. This Greek letter mu is indicated in the second equation given here, so it's actually called a markup. What it is, how can it be derived, we would see it in this particular exercise. So first, let's look at our first formula, which was given in the question, which says W over P is a function of U, unemployment rate, and Z, the exogenous variables. So if you remember from our macroeconomics lecture, if, let's say, income increased indicates that there would be more activity in the economy, so to say there would be a higher demand in the economy. So this is to say naturally the rate of employment or the rate of employed people would increase. So if income increased in the economy, companies would tend to produce more. Producers are willing to consume more because they have more income. There is a high demand. If there is high demand, companies would tend to produce more. If companies tend to produce more products, that is to say they would employ all their resources. This includes normal employees. So this impact of an increase in income would be translated to an increase in number of employed persons. So the number of employed persons and or the employed rate would increase. This would automatically mean that our unemployment rate would be low. So if there are more people employed in the economy, or if the employed persons are increasing, then our unemployment rate would be low. So if unemployment rate is low, what would be the implication on the wage? This would have an implication to say that wage would be higher. We have already said that income increased. There is a high demand for a resource to be employed and to start producing. There is a high income, there is a high consumption, there is a demand for the product, so companies would tend to produce more. to produce more, they demand employees, or they want employees, they want to employ resources. So if they want to employ employees, or they want to increase the number of their employees, they will have to attract these employees by the form of offering a higher wage. So wage is increasing implies that that increase in the wage has to be somehow covered by the company. So the company is intending to increase the price level, which it will use to hire more resources in its production line. So in short, we have seen that if there is an increase in income, there will be an increase in demand, and there would be an increase in consumption as well. If there is an increase in consumption and if there is an increase in demand, companies would tend to produce more. So if aggregate demand increases, there is a high demand in the economy. So companies would tend to produce more products in order to meet this increasing demand. If companies would want to produce more products, they want to hire more employees so that they can manage to produce the required amount of products in the economy. So that is to say, the number of employed persons would increase. If the number of employed persons increase, previously unemployed person is now employed because of the high demand. So the unemployment rate would be lower than the previous period. So unemployment rate is low. This again reflects in the wage structure, because if companies want to hire more employees, they will have to attract, or they will have to compete with other companies with respect to wage. So in general, the wage would increase. If the wage is increasing, companies should adjust their income structure, so to say, what they charge on the price, they will have to adjust it so as to get additional amount of money to pay the extra or the increased wage. So if wage is increasing, price would automatically increase. This therefore leads to a conclusion that if wage is increasing, price would also increase. So this is again to say wage over price would increase as the entire term. So having seen this relationship, we can see that unemployment decreased. This is again made by a condition where we say the real wage increased. So the first setting that we are looking at now tells us that, okay, real wage is a function of unemployment and external exogenous variables. So we have just seen there is a negative relationship between real wage and the unemployment rate. So this is again to say we can rewrite the formula saying that price multiplied by a function of unemployment rate and Z, where unemployment rate is a negative relationship with wage. In addition, we have to make an assumption that our exogenous variables would have a positive relationship with the wage. So if our function, our entire function, increases overall if our unemployment rate is decreasing, because we have said there is a negative relationship, and if Z is increasing. So this relationship of wage and price with unemployment rate and exogenous variables is called the wage setting curve. And the wage setting curve depicts that there is a negative relationship between real wage and unemployment rate, as we have just indicated with our scheme of arrows and with our trend of the economy that we have just followed. The second equation we are given in the question is real wage is equal to 1 over 1 plus mu. So again, we will make we can make a crisscross here where wage can be multiplied to 1 plus mu to give us the level of the price. So this is to say our price would be equal to wage plus mu multiplied by wage. So if companies are setting up their price, they would want for sure to cover the wage that they are paying, which is part of the cost structure of the company. So a price of a product should always incorporate the wage paid for that particular product. So companies, when they are setting price, they would consider what wage that they have paid for their employees, W, and they would have some sort of markup, which is represented by mu in our formula, which is multiplied with the wage. So they would apply some sort of markup to the wage, plus the wage would give the price level. So this is to say, at the end of the day, companies are charging the price which is actually higher than the wage level. So this is to say, if a company is producing some sort of product, and if a company has some number of employees, they would consider the wage they paid, they would multiply that wage with a markup, and they would come up with a price level which would be profitable for them. So to say, they have covered their wage expenses with the price, and they have got additional profit out of this business that they are conducting. So this formula indicated in our question, which says real wage W over P is equal to 1 over 1 plus mu, is called the price setting equation, because as we have said, to set the price, companies would take into consideration what wage they are paying. They would multiply that wage with some value of markup represented by mu in our equation, and then adding up the two values, they would charge a price, or they would set a price. So this is why we say this particular formula given here is called the price setting formula. So now in the labor market, we have seen two types of curves. The first is the wage setting, and the second one is a price setting. There are some additional informations regarding the price setting. So we have said that there is a markup of mu in the price setting. So if there is a perfect competition in the industry, mu would be equal to 0. So this is to say companies are setting price to be equal to wage. If there is a perfect competition in the economy, they would like to have more employees, or they would like to win the competition. There is a competition in setting price, and there is a competition in setting wage as well. So they would apply a markup of 0, which gives us wage is equal to price. However, on the other case, if there is a monopolistic competition or a monopoly in the industry structure, we would have a very high value of mu, where companies are using this mu to set higher prices. So in usual case, monopoly can control the price, can set the price, can set high prices. So they would set the mu value to be very high, so that they would charge higher prices, although they are paying a certain amount of wage in the form of W. So as you can see in the price setting formula, or in the price setting equation, we don't have any unemployment rate. So unemployment rate is only included in the wage setting formula, which we have already mentioned earlier in this discussion. So please note that there is no unemployment rate in the price setting formula. So the next thing we want to see is how this combination of the two formulas or the two equations provided, that is to say the wage setting and the price setting curve, would look like in a graphical representation. So as you remember, we have said our price setting real wage is equal to 1 over 1 plus mu. So we have a price setting here which is 1 over 1 plus mu, and this is actually not dependent on the unemployment rate. As we have just said, the price setting is not dependent on the unemployment rate. So 1 over 1 plus mu would give us the second formula, which indicates the price setting curve. However, we have seen that the wage setting formula, which is the first formula, depends on unemployment rate. So we can depict our wage setting curve, so to say, something like this. And this represents our first equation, which is the wage setting curve. So at this point, we have an intersection between wage setting and price setting. So this gives us UN, which is called the natural or the structural level of unemployment rate.